Something that makes one rental at a time a very different channel is I don't pretend to be an expert in areas that I am not. I bring on folks who are in the mix each and every day. And today we're going to have a conversation with the guys from Convoy Home Loans. First video we're going to do with Dustin. Second will be with both Dustin and Jonathan. But Dustin, we got to talk about what's going on in the market. I don't know where you want to start, but mortgage rates are over 7%. Civic got sold. PCE Q1 came in hot. DSCR loans versus conventional, just all kinds of stuff going on. What kind of hit your radar? What is most interesting from your perspective, given you're in the mix every day?
Well, week over week, we obviously were on last week, but we've seen rates cross that kind of 7% barrier, which, or not barrier, but line, I should say, which is going to cause a barrier for a lot of, either first-time homeowners or just your, typical kind of investor that's, looking at the market, and now he wants to wait to see rates come back down. But I think, there's a lot of talk about the debt ceiling, of course, and how that's causing a lot of the rate increases. But in reality, that should bring a lot of traders over to treasuries and shorter, safer debt, right, or investments. But it's really just the change in sentiment that the market now believes. I think after PCE this morning, I think it's over 50% that they're going to be a rate hike in July, and that's far different from 2 weeks, 3 weeks ago. People thought there'd be a cut in July.
Yeah, so it's going to be really interesting. PCE, let's talk about that because we actually get 2 PCE readings this week. The one that came out today, which came in hot, came in at 5% versus expectation of 4.9, is a review of Q1. We will get the April PCE reading, which will be the first month of Q2 tomorrow. The Q1 number is a little lag, but yeah, it did come in hot. We've seen several inflation readings come in hot. We've got Jamie freaking Dimon talking about a 6% Fed funds rate. I don't see how we get there, but boy, Jamie Dimon, he's talking higher for longer. What did you think of that conversation?
Yeah, I mean, I think it kind of plays on the fact that I believe he knows, and a lot of us know, that even though the Feds may have thought they were winning or won, they clearly have not won the inflation battle. And I think to get there, we've been saying it for the last year and a half, they were going to have a lot of hikes. But the way that they're doing it in terms of, my belief, slowly ripping the Band-Aid off didn't help our case. That's why we're sitting here longer. So I don't know if it gets to 6, but anything in this market right now, like, I don't know what to tell Jamie Dimon he's wrong and I'm right. But
oh yeah. Yeah, I don't think we play that game. It'll be,
no.
it'll be interesting to watch. One of the things that I do think is interesting, because not only do I talk to experts like yourself and Jonathan, but I talk to real estate agents as well. And what they're telling me as of this week, this could change next week or the week after, they're not seeing a slowdown in demand yet. Now, some of that's because supply is down 40% from last year. But according to a lot of the real estate agents, the shock factor is just not there, right? When we hit 7% for the first time in July of last year, it shocked the market because everybody was used to 3.5. Now we've been bouncing around mid 6s for 6 months or whatever it is, with a couple of momentary blips to the low 6s. That 7 doesn't feel as bad. So I'm curious if in the loan business you've seen cancellations or withdrawals or whatever you call it in your pipeline with rates going over 7 for owner occ, and I'm going to guess over 8 for investors, but that's just a wild guess. What's going on?
No, I completely agree with that, and that's kind of one of the things we had been hoping for, was just some sort of narrower, more consistent trading range for rates, right? Because when you go from 3.5 to 7 like a year ago, that's going to shock the market. But
yeah,
you go
boom.
From 6.75 to 7 back to 6.75, like, your payments aren't going to fluctuate that much, but the sentiment in the first time home buyer, your investor, it's not like it was a colossal change in regards to their affordability or anything.
Yeah. We mentioned in the opening that Civic got sold. Remind folks what Civic is. So some people know, some people don't. What does that all mean for folks?
Yeah, so over the past couple of years, several years, Civic's arguably been one of the biggest lenders for real estate investors, right? They do a lot of short-term like bridge debt. They do a lot of DSCR type deals. I think it was what 2 months ago when they initially let off like 40% of their staff, right? Now, PacWest owns Civic. I think they bought them in 2021, but PacWest sold Civic, which is the real estate lending portion of PacWest, right? For residential, I should say, to
Right.
Rock 360 in on Wall Street. And they're not keeping, from what I read, they didn't share the financials of it or the deal. But all of the previous, loans that were serviced by Civic, that wasn't part of the deal. But all active loans and all, future loans, of course, are now going to be run through Rock 360.
Wow. Again, there's a lot of change going on. I'm telling folks, I think we're still in the first inning, and really the first batter is still at the plate. We're really early in this. This is going to play out over years. People, I think, inaccurately think this is going to be like some V-shaped down and up. This is going to be some slow grind for quarters and maybe over a year. What are you thinking of that?
No, I agree. We've been saying that this is it almost feels like every month we get like a little rate drop decrease, and everyone's, thinking that the momentum or the new tide is here, that we're going to have rate, but it's, we're just getting started. You're seeing it not only with you know what's going on with the banking crisis, but rates moving. And I'll share a little bit about our company that we're seeing. And normally I don't like to do this, but for example, we'll sell a lot of our loans after we close them, right?
Right.
And normally we'll sell them in bulks. The smallest bulk will maybe be 50, but we had a bulk order of 100 at the end of March, beginning of April, that one of our investors on Wall Street had a full commitment, to buy. They're going to give it to us at even price, just take it off of our books, take it off of our warehouse line. They rescinded on that last week. So now we're sitting here with, 100 loans that me and John have to think, is it worth paying, a quarter point or half a point on the full balance just so we can lend at that amount again? Or are we going to ride this out for another month or 2 months? Because it's a writing on the wall that I'm seeing that, investors on Wall Street, when you tie in what Fannie and Freddie were doing with those repurchase requests for some of the IMBs, like Wall Street's going to start doing their equivalent. And that's basically bait and switching us, saying that, hey, yeah, we'll buy all of these at this price, but no, we're not going to do it anymore.
Just
We're going
kidding.
to. So that's a fun thing that a lot of people may not know about, but a lot of the
Yeah.
clients that we speak with on your channel, we're always telling them, like, look, the cost has changed, and unfortunately, it's above
Yeah.
my pay grade to decide that change.
Yeah, it's really interesting because I think one of the things that Jamie Dimon, to go back to that speech he was telling us, is the landscape is still shifting. I think a lot of people hope we're at the bottom and the foundation and they're comfortable riding the foundation out for a while. I think what Jamie Dimon is really highlighting is, I think what you've just shared with us, it's not settled yet. It's still on sand, and there's more shockwaves to come, and you don't know where they're going to come from.
Yeah,
That's what I think Jamie Dimon is warning folks of.
I completely agree with that.
Yeah. Well, the last thing I thought I would ask you about, I don't know if you saw this, but I'm guessing since you're in the business, you did. Rocket Mortgage copied, tweaked something that UWM put out, said, hey, let's do 1% down for, I think what Rocket did was 80% of area gross or area median income. UWM first did it at 50, but has subsequent raised it or matched 80%. What do you think of these 1% down loans? Are they just marketing material? Is there real appetite for them? What do you think of these things?
So, I mean, yes, it is a big marketing play, right? And UWM and Rocket have sat at the top of the conventional world for the wholesale. And I mean, UWM's only wholesale, right? So if you want to work with UWM, what that means to your viewers is you've got to go through a broker like myself or Matt, the mortgage guy who works with UWM a lot. Rocket has both channels. They'll go directly to clients, or you can, go through a broker and go through Rocket. But, UWM kind of took the top seat in the house for conventional in this
Yeah.
past year. So anything that UWM does, Rocket's going to have to match, right? And they've got Rocket's doing a little bit more of a outreach with their personal loans and credit cards, and
Yeah.
UWM is going to stay true to just doing conventional, or not conventional, but residential mortgages. Do I think it helps? It definitely helps. I'm not going to lie to the viewers here that we haven't had a lot come across in the 50 to 80%, a median income buying first time homes in Los Angeles, right? So
It doesn't
like,
happen in LA County.
no,
That's shocking.
yeah, I think we actually have one or two, one of our LOs down in San Diego. The property's not in San Diego, but he's got, two 1% down with UWM, I think in a suburb around Atlanta.
Okay. Yeah.
Yeah.
So again, I think these are interesting. I think anything that gets somebody on the property ladder is a good thing. I don't know that 1% down leaves me all warm and fuzzy, but again, when you look at kind of the package they both put together, it can lower expenses because I think one of the wrinkles is it removes the need for PMI or something like that.
Yeah, and they're, if you're still, let's say if you bought, if you're in the 50 to 80%, they're doing the rate build in,
Yeah.
even though there's no monthly mortgage insurance that you see,
Right.
it's
It's in
built
there.
into the rate. So it's once again, it's a play on words, it's a marketing play to tell
Sure.
them, hey, mortgage insurance, but the way that it's getting paid is you're getting a higher rate.
Shocking.
Yeah,
Dustin, come on, stop telling the industry secrets.
yeah.
Oh man, lots of fun stuff. Anything else going on just in the world? Obviously, we have a jobs number that comes out next Friday. We got an inflation reading the following week. There's a lot. We got a debt ceiling debacle that's going on. I think all of these things lead to higher rates. I think it's why we're over 7%. Hopefully, in the next 60 to 90 days, we start going the other direction. But yeah, the last thing, there was a lot of people calling for 5% mortgages at the end of May back in January, which I, of course, chuckled at. Uh, to be clear, I thought we might see 6, so it's not like I'm much better. But wow, 7% caught a lot of people by surprise.
Yeah, I think maybe our video a month ago was you, me, and John kind of putting wagers out there whether we thought we would see sub 6 by was it
August.
yeah.
August. Yeah.
I'll rescind on my initial.
You're already giving up? Oh, come on, man.
Yeah.
That is hilarious. Well, if somebody wanted to reach out to Convoy Home Loans, see what's going on, see what program works for them, how would they reach out to you?
Yeah, just go to our website, convoyhomeloans.com, click the drop down menu, say you came from ORAT.
Thanks, buddy. Appreciate you.
Thank you.